Hello and welcome to the last lecture 35 of the course Forex in 3 steps. This is one of the most modern strategies, very popular nowadays. The SMC or the smart money concept is a trading strategy that revolves around 3 main concepts or 3 main foundations: market structure, supply and demand, and liquidity. In this lecture, we will cover everything you need to know to be able to trade smart money concepts and to be able to understand all the basics of smart money concepts. However, this is one of the more advanced types of strategies that requires lots of practice and lots of hard work if you are willing to trade using this strategy. This strategy is all about reading and looking for market maker involvement in the market. Of course, we all know by now that market makers are the ones that move the markets. What are market makers? Market makers are basically financial institutions, banks, whales with plenty of money and plenty of capital that they can invest in markets, which causes the markets to move in their way aggressively. But of course, these financial institutions and whales and banks, they cannot buy and sell through the market instantly. And that is why they leave behind footprints where we as retail traders can identify where they're buying and where they're selling. How do you identify these footprints? By understanding how smart money works, how and when they buy, and how and when they sell, and what types of patterns we see when they are buying and what types of patterns we see when they're selling. In this lecture, we will cover everything you need to know about smart money concepts. So let's hop straight into the charts. So firstly, let's talk about market structure. Market structure is the foundation of trading, and it is definitely the foundation of smart money concepts. And basically, all market structure is basically identifying the trend, but more accurately. With smart money concepts, you need to start focusing on the highs and the lows, and you always need to be in check which one is controlling the market. So in this example, we have a very strong uptrend, and of course we are breaking from left to right bullishly. And if I take my trend line and just draw it sideways, you will find out that price keeps breaking structure bullishly. And I usually label this by having a bullish boss, which means a break of structure. And here again, same goes here, where I have a bullish break of structure. With smart money concepts, usually expectation is that the trend is your friend as well. This is a foundation in smart money concept, and usually predictions are always that price will make a pullback and continue breaking to the upside until prices start losing the low. And same goes for downtrends as long as we are continuing to break bearishly, it means that price is likely going to continue bearishly until this high breaks. As soon as this high breaks, then it means that price has reversed, and it is likely that a new trend will establish itself and start going to the upside. Something I really like doing is taking a horizontal line and placing it on the strong lows or strong highs, of course, in a downtrend. So if we are downtrending, that means that the highs are the strong ones, and I usually like to do that just to make sure that I know that this is a strong low. We should not be visiting this low, and even though we can visit it, we should not be closing with a body candle below this low. Because why? Because lows here are in control of the market. As you can see, the lows keep on breaking the highs. This low also broke this high, this low also broke this high, which means that the predictions and the order flow objective is to keep going into this trend. There are various levels of market structure. So for example, now that I am on the 4 hour, this can be your 4 hour structure. Just like we took with the swing trading strategy, we also have in smart money concepts, we have various levels of market structure. We have three mainly, but you can even keep on going lower and lower, and you can be able to keep zooming in more and more and seeing and drawing market structure on whatever time frame you'd like. But all you need to know is that even though we are in an uptrend right now, inside this 4 hour structure pull, I can also, if I go for example on the 2 hour, I will see that price is doing something like this. Inside the 2 hour, I will see that there is also an internal bullish trend inside this 4 hour trend. I can see it on the 4 hour, but if I zoom in on the 2 hour, I will see price doing that. And how does this help us? It also helps us the same way with the swing trading strategy that we covered. As soon as the intermediate trend starts breaking to the downside, so for example in this case, if price does something like this and starts breaking to the downside, this is an indication that a pullback will start. And that is why it is very important to always start with a top-down analysis and start your analysis from a high time frame and move your way back to the lower time frames and keep drawing market structures that you find valid in order to be able to identify several trends. And of course, the general rule of thumb is that as long as you have a primary structure, which is in this case the red structure, and you also have an internal structure, both pointing the same way, so in this case both are pointing up to the upside before we broke bearishly here, this is a very nice time to buy. But as soon as prices start breaking, for example here the internal structure started breaking to the downside, this is an indication that the internal trend is moving to the downside and the primary trend is moving to the upside, and this is not the best time to buy. But you can of course scalp whenever you want. Scalps are always available, but be careful when the internal trend is moving down to the downside and the main trend is moving to the upside, because now that you are trading against the internal trend. But when you see this, it means that a retracement is about to happen and prices should start making its way down towards, for example, a demand zone or whatever. So for example here let's just assume that there's a demand zone, and we will cover demand zones later on in this video. But in this case here, we made a pullback, and as soon as we start realizing that price is breaking back bullishly, this is an indication that price should be targeting this high right now, which is at $4,000, because just like we came here and then we retraced and then we went back up and even broke further this point. Same goes here, we went back and then we went back up as soon as the pullback was complete. I'm very sure that if you also zoom in this leg, we will see something like this as well. You will find out that price also broke bullishly just like here, and this is usually the indication that price will go and target the previous high and even break it, since we are in a very bullish uptrend. And whenever we see this happen, this means that the internal trend is back bullish and the primary structure is still bullish, of course, as long as we did not lose this important low. This important low broke structure, and therefore this low is very important. It should not be broken, and we expect price to bounce before we touch this low. And this makes trading very easy when you know where the strong lows are. So for example, in this case, I will mark this as a strong swing and this as a weak swing, because I know that the target is here, since the trend is bullish and we always want to trade alongside the trend. and expectation here is for price to even come further. You can even look for, in this case for example, you can even go further to the 15 or to the 30 minutes, and you can even check and see what structure is looking like in this leg. I can keep zooming in to whatever I like, but just keep in mind that the lower the time frame, the worse chance you have with trading. So keep in mind that you should not be going very low on the 1 minute or even the seconds. You should stay always between the 5 minute to the 1 hour if you're scalping, and if you're swing trading, you can stay on the 4 hour to the daily, for example. But in this case, I can even, so here we broke internally back to bullish, right? And this was also a bearish internal break, and this was not good. Of course, this meant that we retraced, and we actually did, and then price moved back towards a demand zone. Then price started breaking to the upside once again. And if I start pulling another structure pull, let's make it blue here for example, and you will find out that price may do something like this even on the 30 minutes, and that means that this I call it fractal. So basically the three market structure levels are the primary structure and the internal structure and finally the fractal structure. You always want to focus on having all of them pointing the same way. This is the best chance of winning trades, when you have all three of them pointing the same way. When you have two of them, for example here, if you have these two, the primary and the internal, looking one side, and this one is not looking the same, this is also a good time to buy, and this is the best time to buy. This is also a good time to buy because the fractal structure is the weakest and it is the lowest time frame. So these two overrule the fractal structure. If you have the primary structure pointing upwards and then the internal structure starts pointing downwards, this is an indication that you may want to start skipping trades and not trade at the moment, especially since the trend is not identified much. But of course, if the internal trend, as soon as the internal trend switches and it looks like this again, this is a good time to buy. And the last scenario is when you have the primary structure pointing downwards and you want to, for example, buy, and the internal trend is alongside you. This is a good time to scalp, but not be careful, because the primary structure, you are still trading against it, so keep that in mind. And this is basically how market structure works. Let's jump into the real chart and see how we can draw structure here on gold, for example. So on gold, let's jump to the 4-hour chart and let's just start pulling it from here. If I want to draw my structure on gold, let's remove this. If I want to start drawing structure on gold, I will just pick my path tool and make sure you are drawing with the path tool. The path tool, you can find it here. If you click here, you will find it here. Do not draw with the trend line, because as soon as you click double, you have to pick another one, and it's way longer. So if you pick the path tool, you just as soon as you click once, let's make this bigger. As soon as you click once, you can continue with drawing the trend, and it will not stop until you click right click. And here we have the market structure for gold, and as you can see, as soon as we start breaking, we usually, here we do not have a pullback, but here after we broke, we got a pullback, and then here we broke again and we got a nice pullback, and here we got a break, another break, and we got a nice pullback. So the markets are always moving in this type of format, which means that it is very important to understand how market structure works. The most important rule to understand when you're live trading and you're analyzing the market structure in real time is make sure that before you draw a pullback, it is significant enough to draw it. So for in this example, for example, I won't. So let's just show you what I mean. So in this case, we went up and then we made a pullback, correct? Okay, let's measure the pullback. The pullback here is around 2%. Okay, so this is a valid pullback. Here we also made another pullback which was almost as well 2%. Here we made another one which was almost as well 2%, and the number I'm looking at is the one under my cursor right now. So as you can see, if I measure from this high to this low, okay, and I just click shift and click and then drag, I can see that the measurement says that this was 2%. So this is also valid. Here we also made a 2% retracement, and this means that it's also valid. And this is a nice way, not really SMC related, but measuring pullbacks is a good way to identify how deep the pullbacks go, and this can help you as well with looking for trades and knowing when the pullbacks end. And finally, we have this pullback. So people here may not know if we should draw this as a pullback and consider this as the low or not. Of course, something that you need to understand very much is that a low must hit a high before we draw it. So in this example, for example, if we have price doing something like this, this means that this low is not confirmed yet. Why? Because it hasn't done its job. And what's its job? Its job is to take out the previous high. So every low has a target that it has to hit the high, and after it hits the high, then we confirm it and we can come here and draw a line, because this means that this should not be broken. However, if price, in this case here, it did not, the price action, we made a pullback and then we went up, but we did not we did not go up significantly, and we did not take out this high which is supposed to be taken out. This means that this low did not do anything to be considered a low. This low needs to take out this high before we consider it as a low. So in this example, I'll ask you a question: where is the strong low? Where is the low that we need to consider, and where is the low that we should not be considering? The low we should consider, and the low that is confirmed because it did something, is this low. Why? Because it was able to take out this high. It was able to take out this high, and it even broke it, which means this is a very strong low. But however, this low is not yet confirmed, and we cannot draw structure yet until this high is taken, like this scenario. In this case, we can move this here, because this is now the important low, and this is the low that should not be broken, because this is a confirmed low and it was able to take out the high. Same goes opposite. Okay, so vice versa, if we have something like this and this high did not take out this low, this means that this high is not yet confirmed, and the real confirmed high is this one. So that means that until price is able to take out this low, and this high does its job and breaks this low, this high is not yet confirmed until it does this scenario and takes out this low. And here we can draw structure here, because this high is the high that should not be broken, and if it is broken, that means that a reversal is about to happen. So back to our example. In this case, of course, we cannot yet draw this low as a confirmed low. Our confirmed low in this case is this one, correct? This is our confirmed low. Price made a pullback and it's starting to go up. We'll see how price develops, but this is the low for now that should not be broken. Why? Because it was able to take out this high. It took out this high, as you can see, and broke it, and therefore this is a strong low. And this low is also, even if price had not even closed, so let's just imagine that all this is not here, and price went up and then it failed to close with a body candle close and went back. This means that this is also a confirmed low, because all it needs is not to break it, all it needs to be confirmed is to touch the previous high, and same goes vice versa. A high is confirmed once it just touches the low, the previous low, the low to the left. So in this case, of course, we still cannot consider this a low until we take out this high. But of course, we need to, even if price goes up right now and takes out this high, we still need to measure. But in fact, this measurement is also good enough, and I can draw this as a pullback because this is a sufficient enough pullback, and it is the same as the ones before, around 2%. However, if let's just imagine that price went up and then price went back just a little bit and then it continued up, this for me will not be a sufficient enough pullback, because if I measure it, it is only 0.6% retracement. This is not a pullback for me, and that means that all of this is just a one leg up. And this is very important when drawing market structure, because drawing market structure is a skill that you will need to be able to identify everything and identify the different market trends depending on the different time frames. And sometimes they can be much more difficult than this. I'm not sure if I can find, yeah, so for example, here, if I start pulling from here, it will get very difficult because sometimes market structure keeps, as you can see here, it can go in a squiggly matter. And the last thing you need to know about market structure is that there is a difference between a break and a SFP. What is an SFP? An SFP is a swing failure pattern. What is a swing failure pattern? I'll show you what I mean right now. And all I mean is, if we are trending up and price hits a high, so in this case, for example, price is trending to the upside and then price hits a high but fails to close with a body candle. That means that usually signals that this low is weak because it was not able to close above this high in a strong manner, and that usually indicates that a reversal is about to happen, and this low is not sufficient and it's not strong enough, and it is actually weak in nature. And that is why prices usually, as soon as they fail a high, it usually means that a rotation is likely to happen. And what does this look like? It looks exactly like this. So for example, if we have, I'll draw it real quickly. It usually looks like something like this, where we have an important high and price reaches this high and does this pattern. What does this pattern indicate? It indicates that price wicked only. As you can see, the wick is the only thing above this high and not a candle body close. But if in another scenario we get something like this is an indication. This is actually a very bullish indication, and if we can get a candle close, a body candle close above this high, this is an indication that price will likely continue in the trend, in the bull trend that is shown in this chart. And that is very important to understand the difference between a break and an SFP, because they're quite the opposite. A break in structure, a break means that price is likely to continue to the upside, but a failure to break in this case means that price is likely to rotate down to the weak low. And that is the first main concept in trading, market structure. Now, the second most important thing and foundation and concept in smart money concepts is the supply and demand. There are two types of supply and demand, very simply. The first type is the very easy type, and if I add back my structure pull, so let's pull it again. We went high, we put in a low, we went high again, we put in another low, and then high, low, high. So all you need to understand is the demand and supply are created by breaking structure. So you cannot confirm a demand zone or a supply zone unless price is able to break structure, and then it forms a supply or demand. The first type you need is called a demand range or a supply range, and it is basically you grab a box like here, from here. Okay, you go into the shapes area and then click on rectangle, and all you need to do is drag from high to low and then pull it to the side, and there you have it. You have the first demand zone that is a demand zone in smart money concepts. Why is this a demand zone? Because it caused a break in structure. So this whole area, we see that we had a pullback, and then price and smart money were able to buy from here, buy, and then we were able to push to the upside and break structure. And therefore this zone usually means that if price retraces back to this zone, it means that this zone is a very nice zone. And as you can see here as well, if we go back here and we see that price closed this candle bullishly, price actually immediately, the candle after immediately touched the demand zone and it took off from there. And that is because price was able to make a pullback and then make a V-shaped return and break structure bullishly. And that is of course an indication, a very bullish indication, and that means that the whole area we broke out of is considered demand. This is the first type. It is not a famous type, but this is a famous type. The cons of this demand, identifying demand zones and supply zones like this, is it usually leaves you with a very wide and large demand and supply zones, and people usually do not like this because they want just a small area where they can put the stop loss below it and just enter as soon as the area hits. But personally, and for best, you should always wait for confirmation. Even if you know that this zone is a very strong zone, you should always wait for price to pull back and make a confirmation. Whether you want to use a divergence, an indicator, a chart pattern, a candlestick pattern, or even wait for market structure to shift, these all work perfectly. But you should always, even if you identify a very strong demand or supply zone, you should always wait for confirmation. Supply zones are also, we have a supply range, which is also basically the same thing. We also need to wait for, so for example, if I draw my structure from here to here, I will come up with this. We have a high, we have a low, we have a high, we have a low, and then we went up, we had here a high, we had a low, and then we broke up once again, but started breaking bearishly. So if we take this low until this high and pull it to the side, we will have our first supply zone. Why is this a supply zone? Because this was the last buy to sell, and we also we went to the downside with a V shape, and we also broke structure, which means that the whole area that was able to break structure bearishly and reverse the trend is considered a supply zone. And from here you can also look for whatever pattern you want, a head and shoulders, a double top, a divergence, an indicator, or whatever, and you could have entered here from this supply zone and took it basically down towards this demand zone. And this is how easy it is to identify demand and supply ranges. And as you can see, by just simply just seeing where the V-shaped breaks are, you can identify the strongest demand and supply zones. In this case as well, price actually here it broke also, but it broke on the 15-minute, because I remember this trade on gold. We basically price when it dropped here, it broke on the 15-minute, and then this we had another break here. It's an internal break, but it's still a break, and a very strong break as well when you have this last sell to buy. And when the buy is like a V, if I draw it, you have a V. This is a very strong indication that this zone is a very strong zone, and as soon as price hits, it also bounced very aggressively, and until now you could have basically banked this trade with a very high risk to reward ratio just by understanding basic supply and demand and waiting for confirmations. The second type is basically looking for sole order blocks. What are order blocks? Order blocks are opposite colored candles that act as support and resistance, and I'll show you an example right away. So now that we have covered demand ranges and supply ranges, now we will take the pivot demand and pivot supply. And all the difference is that you are also looking for the last buys to sells, but the only thing is you are looking for just one single candle and not several candles. That is the only difference between these supply types and demand types. So again, we in this case we when we take a demand range, you take a whole break. You take a whole break, and it can consist of several candles. But in this case, you have supply, and we only took one candle, which was the last buy candle before an aggressive sell. And usually when this happens, price, when it retraces back and touches this candle, all you need to do is draw a box from the low of the candle and the high of the candle, not the body low and not the body high, and so not the open and close price, but actually the low of the candle and the high of the candle. And if you pull it, you will find that supply zone was created, and it was a very strong supply zone actually, which caused a very aggressive move to the downside. And you still need to wait for a break. So it doesn't matter, not because this is just by finding one candle you will find them everywhere. Yes, you will find them everywhere, but this candle needs to have done something and to be able to take trades from. And in this case, this was the last buy candle before an aggressive sell, which actually caused a break. We actually broke structure. We barely broke here. This was not a break, but we broke here, and this was an indication that this is a valid zone to enter from, because it broke structure. It needs to break structure. If price had not done this, if not price had started retracing from here and not broken to the downside, this would not have been a valid area to take a short trade from. And same goes vice versa. So for example, in this we had another case here where if I jump to the 18-hour, actually the 8-hour, if I jump to the 8-hour, you will find that price also retraced to inside a nice demand order block, which is again a sole candle, which was a sell before an aggressive buy, which caused a break. So in this case, if I pull my structure from high to low, we went down, we went up, we went down, we went up, we went down, and then we broke bullishly here with a body candle close. And if I, after a break, usually you want to look for entries, because after a break it usually means that there is bullish momentum and price should retrace and keep going towards this new break. And that is exactly what happened. Price after the break made a nice retracement towards this order block, which was basically the only order block remaining that was not mitigated and not hit. And then price moved, and you could have entered here with any confirmations and targeting this high. Something else you need to know, that as soon as you have a demand zone, as soon if it starts getting touched, if it gets hit once and then price moves and then price drops again towards this demand zone, this is not a valid demand zone. This demand zone ends as soon as it is touched once, because this is not a support zone. This is a demand zone, and there's a big difference between support zones and demand zones, and there's a huge difference between supply and resistance. Same goes for a resistance zone. If I have a nice resistance zone from here and price hits it once and then drops a little and then it is going back towards this resistance zone, you should clear this resistance zone and not remove it from your chart, because it means that the resistance zone has been mitigated. And when you have a demand or a supply zone that is mitigated, it means that it is not likely to work. So basically just look for entries as on the first touch of a zone. So as soon as we hit this zone, you can start looking for this zone because it was never touched before. But if we hit a zone and then move a little bit and then come back to it, do not look for another trade. And that is the second type of demand and supply order blocks. And the third concept is liquidity. Liquidity is a fairly simple uh, concept in smart money concept, and it is basically looking for highs and lows that are not taking each other. So basically below every low and above every high, you usually have liquidity. What is liquidity? It's basically orders that are usually stop orders that are being placed above highs. So for example, in this case, when price went up here, people looked for shorts and people put their stop losses above the highs. Usually the safest place to place stop loss orders are above strong highs and strong lows. And in this case, people definitely had stop loss orders here. Same goes here when price retraced up here and then started breaking to the downside. People who entered shorts from here, and here, they all put their stop losses above here as well. Same goes here and same goes here. And how do market makers take orders and fill their orders? By grabbing liquidity. Liquidity is like a magnet. It's like a magnet tool that grabs price and pulls price towards it. As you can see here, there was a very nice trail of liquidity on gold, which caused price finally to reverse and take out all this liquidity. Another very nice example for liquidity is when Bitcoin kept making lower lows and lower lows, each time grabbing liquidity until price finally kicked off and moved very aggressively towards the upside. And basically what's happening here, of course there's a nice head and shoulders pattern here, but back to liquidity again means that we had stop loss orders below this low, and how do smart money and how do financial institutions and whales fill their orders? Because their orders are very huge. They require lots of opposite selling or buying in order for them to buy or sell. So for example, if the smart money, if the whales and the financial institutions and the big money wants to buy a certain asset, like in this example they want to buy Bitcoin, they usually make price actually fall. They usually make price fall down in order to keep grabbing liquidity, because again, what is liquidity? They are stop loss orders. So people who bought here and here, where do they have their stop loss? They have it here. And when a market maker pulls price back and takes out a very important low like this low, it means that everyone who bought here and here and has their stop loss here, it means that basically all these people sold their positions. All these people who bought sold their positions with a loss, and the market maker actually buys at these times. And that is why it is very important to indicate and identify the important liquidity zones on the chart to be able to know where the market maker wants to enter, because they usually enter at liquidity pools, especially if they're huge liquidity pools. And in this case it happened again. So people who entered here, and some retail traders are smart, they usually wait for liquidity grab before they enter, and that definitely happened here. But at the end of the day, they also put their stop loss here, and it's not an issue of stop loss, it is just an issue of manipulation. And this is just how the markets move, and smart money moves around in the markets, because they require lots of opposite type of sells in order to buy, and vice versa. So they also require a ton of buying in order for them to sell. So they manipulate the market by making retail traders sell into their buys and buy into their sells. So basically what happened here was, again, people set their stop losses below here and people started entering long trades. And again, what happened? Price at the end reversed very aggressively, grabbed everyone who put their stop losses below here, and then the market maker caused these people to sell their positions in order for him to buy. And then he bought here once more, he confirmed a nice model, and prices reversed ultimately reversed at the end. And these are the three main foundations of smart money. Of course, this is a more advanced and more modern strategy, but it is one of the most successful strategies, and it is fairly easy if you commit to it. So again, market structure, supply and demand, and liquidity, they're all very important, but make sure you keep practicing and being able to identify them easy to be able to successfully succeed in this strategy. And that is it for this course. I hope you enjoyed it, and I hope you make tons of profits, and good luck with your trading. Thank you.